Delighted to be here again this year. Last year's experience for me was really a very pleasant and very fruitful experience for me to learn about much broader perspectives on our economic system and capitalism. So I was delighted to be invited back this year, and thank you for this opportunity. Today, in these, 20 minutes or so, I'll talk about whose income and whose value. What do I mean by that? When I looked up the dictionary definitions of capitalism, these definitions, which are, I'm sure, quite familiar to everybody in the room, come up: an economic system in which investment in and ownership of means of production, distribution, and exchange of wealth is made and maintained chiefly by private individuals and corporations, especially as contrasted to cooperative or state-owned means of wealth, and so on. There are variations on that meaning of capitalism. Why do we call it capitalism? Again, there are many explanations, and but I'm going to suggest one possibility, outrageous possibility. It's rarely discussed. Could it be that we call it capitalism because we do accounting from the point of view of the supplier of capital? Now, I know I'm reversing the causality here, but just bear with me for a minute. Because we look at accounts and performance as currently prepared. And to explain what I mean, let's look at an example. So here's the income statement of Microsoft Corporation. For 3 columns, give you data for most recent year, 2010, 9, and 8. At the top, I'll just read down the 2010 column. They had a revenue of about 62 point some billion dollars, out of which they subtracted various expenses. Expenses were cost of revenue, which in case of a merchandising firm might be the price they paid for merchandise, and this cost of revenue in case of Microsoft will probably be the cost of running their operations. And then there's sales and marketing, 13 billion of it. General administrative costs are about 4 billion. Employee severance pay is about, 59 million. Total operating expenses add up to about 38 billion, which leaves them with an operating income of about 24 billion. And then they have other income or expense in some years, which is mostly interest expenses or interest earned on bank accounts. So they have income of about 25 billion before taxes. And they have made a provision for income taxes, about 6.2 billion, leaving net income of $18.7 billion, or 52 cents per share for the shareholders. So as you can tell, this whole accounting system, the income statement, has been drawn up to focus down to what happened to operations of Microsoft during this year, and what did it mean for the shareholders. Of course, shareholders have substantial interest and investment. There's nothing inappropriate about this particular income statement. But what is interesting here is that this income statement, which is typical of the income statements, not only in the United States, but in all parts of the world, has been drawn up from a particular perspective. Our accounting reports are modeled for the capitalist perspective of the firm because it treats all factors of production other than equity capital as costs. And that is indeed the case from shareholders' point of view. The salaries paid, wages paid to the labor, and other factors of production are costs. And the focus of the statement and most accounting system is on net income to the shareholder. I'll come to residual income concept in just a few minutes, but let me hold back on that. So and of course, corresponding to measurement of net income for the shareholder, there's also corresponding focus on shareholder value as the stock variable of interest. Income being the flow variable, the value of shareholder stock becomes the stock variable. And I'm going to argue that this accounting choice we make has consequences. It not only determines the data we have, but it also shapes the nature of the discourse on the performance and consequences of the economic system. Why? Because it's hard to talk about things on which we do not have the data. This has given us some data about what happened to the shareholders of Microsoft during 2010. What it has not told us is what happened to other parties in Microsoft. So let's imagine an alternative. Look at the enterprise from point of view of all factors of production simultaneously. That does not exclude shareholders. It includes shareholders, but shareholders being one of the parties. And then measure contribution of resources from each agent. That will be the opportunity cost of resources supplied by various participants in the organization, and measure the outflow of resources going out from the organization to each agent. And then the income, the economic income of each agent will be the difference between his or her receipts from the organization and opportunity cost of contributions to the organization. And if you add up this income of each agent across agents, then that will be the total wealth generated by the organization as an enterprise. And if you capitalize the individual or aggregate flows or incomes, that would determine the value of the enterprise to individuals in first case and in aggregate for society in the second case. So just graphically, we can think about, depending on how many factors of production you want to consider, there's capital coming from shareholders or creditors. There's labor from employees. Customers provide the revenue in exchange for products. Vendors provide various physical forms of physical capital and other services in exchange for payment. Government may also provide public services and infrastructure in exchange for taxation. So we can account for enterprise resource flows between enterprise and all other participants in society. Now let's go back and look at Microsoft accounts from this perspective. So here are the list of agents I just had in the diagram. And in the first column, second column has contributions, third column has receipts that these agents have from the enterprise, and the fourth column, last column, has the difference between the two. So Microsoft, or any corporate income statement we just talked about, what does it tell us? Well, for the customer, it told us that customers of Microsoft paid in $63 billion to Microsoft this year. What do we know about what customers got in response? What is the value that customers received in exchange for this money? We do not know. And therefore, we don't know the difference either. Vendors and labor, they are all bunched together into one item in the statement. They are not even separated. We don't know their contribution. There should be a question mark there in the second column for vendors and labor. We know that all these people put together received $38 billion from Microsoft, but again, we don't know the difference. We don't know how much income vendors and labor had from, we know the gross amount is 38, but we don't know the net amount. Similarly, for government, we don't know what was a government's opportunity cost in providing services to Microsoft. We do know that government did or will receive about $6 billion in taxation. Again, we don't know the difference. What we do with respect to shareholders, we know that the total amount of income receipt, it's not really receipts actually, this is not an actual cash flow. $19 billion is the total amount that shareholders will be entitled to if the entire income of the firm was handed over to them. Of course, most corporations don't pay out dividends equal to income. The opportunity cost of capital provided by shareholders to Microsoft is not given in this statement. And if it was entered in column 2, and we take the difference between the opportunity cost of capital and $19 billion of receipts, then in the final column, we could write down the economic income or residual income to the shareholders and creditors, suppliers of capital. Again, traditional accounting model doesn't even give you that. All it does is to give you the gross income, which is in second column, $19 billion. So most of the data needed for estimating how much wealth the organization is producing for various segments of society is simply not produced, not calculated, not reported. In contrast, I guess most people are familiar with national income accounts, at least we know the word GDP, GNP, and all that. National income may be defined provisionally as the net total of the commodities and services, economic goods produced by people comprising the nation, or the other various definitions. I won't go into them. The effect of national income accounts. National income being the end product of a country's economic activity, reflecting the combined play of economic forces and serving to appraise the prevailing economic organization in terms of its returns. And the development of national income accounting and its had major implications. I mean, Simon Kuznets did that in the early part of the 20th century, and it transformed the way we think about and manage the national economy. Let's think about the limitations of financial reporting and its possible transformation in case of enterprise accounting. So, if I may use the label extensive income and value in this context, we could define extensive income or value as the sum of income and value to the shareholders, to the customers, to vendors, to employees, to creditors, government, community, etc. In all cases, the concept being defined as what they receive from the firm minus the opportunity cost of contributions they make to the enterprise. For example, as I mentioned earlier, the income to the investors will be the residual income corresponding to the shareholder value which has been created during that period. But that is not the focus of current financial reports. We could apply similar perspective to other participants. How am I doing on time? Okay, thank you. So similarly, we could do that for customers. Customers have income from organizations. Customers' investment is in the form of search, learning, negotiation, payment, and settlement of disputes. And there is expected present value of benefits from the goods that customer received from the organization, which presumably exceed the present value of their investment in the organization, which includes immediate transaction as well as consequences of future transactions. So similarly, we could define value and income from the enterprise to various other parties. Now, in the neoclassical model of the firm, it's a standard assumption that all the surplus generated by the firm goes to the supplier of capital. And income and value to all other agents is assumed to be zero, both before and after the fact. So there's no need to calculate and report the income, the effects of operations of the organization on any other class of agent. And that seems to be the basis of our current measurement and accounting system. And of course, the recent decades, we have come to think that capital markets are said to be relatively efficient, and at least they're supposed to be more perfect than other factor markets. Now, interesting part is that these two assumptions, that we should assume all the surplus goes to the supplier of capital, and that capital markets are more efficient than other factor markets, are actually mutually contradictory. Why is that the case? Because when these different class of agents negotiate the prices with the enterprise, with their market power and so on and so forth, one will have to ask, how is the total surplus generated by the organization divided among various agents? And most people I talk to are inclined to think that that surplus will be divided among various agents depending on how perfect is the market in which their factor of production is traded. And more surplus will go to those factors of production which are traded in relatively imperfect markets, and less will go to those factors of production which are traded in perfect markets. Well, if markets for capital are relatively perfect, we should expect that suppliers of capital will get the smaller piece of the surplus over and above the opportunity cost, and not the other way around. So we need analysis of extensive income and values for both policy and as well as individual decision making. And we can't have this data unless we we modify and transform our accounting measurement system. Do I have a minute or two? Okay. Just in the remaining minute or so, let me just give a sort of back of the envelope example of, let's go back to Microsoft since we used that example. How much wealth has Microsoft created in society? Let's just start with Bill Gates. How much money does he have? Let's pick a number. 100 billion, is that large enough? 50 billion, okay, it's come down. All right, the top of the market was 100 billion, okay. So let's suppose it was all surplus. He didn't start with much capital to begin with, okay? So Bill Gates' share of the surplus generated by Microsoft is 100 billion. That's a lot of money, okay? Let's say that's a share of the surplus that went to suppliers of capital, Forget Paul Allen and other people. How about employees? How much of the surplus has gone to employees of Microsoft? I'm told there are scores of billionaire employees of Microsoft, and just hundreds of people who made hundreds of millions of dollars per person from their employment at Microsoft. And that amounts to at least $500 billion, another one. What about customers? What's the customer share of Microsoft surplus? So I pay, let's say, $200 for this software, PowerPoint or Microsoft Office. What is the benefit I got out of this? Huh? Internet and all that, right? So my individual benefit, I would imagine, is $10, $20, $50, $100,000, each of us. How many customers of Microsoft, paying and non-paying customers? Okay? That comes to at least one order of magnitude above the surplus that was generated by Microsoft for suppliers of capital. Now, that may not be the case in general, but I suspect it's not an unreasonable proposition that surpluses being generated by various factors, by enterprises for various factors of production, are not trivial. And our model assumption in economics and assumption in accounting that all those surpluses do not need to be measured results in a huge distortion of our social discourse about our capitalist system and about our business policy. So because I see, I have difficulty finding a theoretical justification not only for our accounting system, but also using shareholder value for public policy decisions. Because while shareholder value is perfectly sensible value to look at from shareholders' point of view, but for social policy point of view, we have to look at the value generated by the organization for society as a whole. But I suspect Kaplan's law of the instrument works because the accounting system measures the value and income created for the shareholder. All our large part of our attention and debates get focused on that number, which is in fact available to us. So to conclude, income and value concepts are driven by perspectives of capital alone right now, and they have their limitations and contradictions, as I pointed out. For important classes of policy matters, we may need extensive concepts of income and value, and we might take some useful lessons from national income accounting. Thank you. $13 billion of it. Our general administrative costs are about $4 billion. Employee severance pay is about, how much? $59 million. Total operating expenses add up to about $38 billion, which leaves them with an operating income of about $24 billion. And then they have other income, or expense in some years, which is probably mostly interest expenses or interest earned on bank accounts. So they have income of about $25 billion before taxes. And they have made a provision for income taxes, about $6.2 billion, leaving net income variations on that meaning of capitalism. Why do we call it capitalism? Again, there are many explanations, but I'm going to suggest one possibility, outrageous possibility, is rarely discussed. Could it be that we call it capitalism because we do accounting from the point of view of the supplier of capital? Now, I know I'm reversing the causality here, but just bear with me for a minute. Because we look at accounts and performance as currently prepared. And to explain what I mean, let's look at an example. So here are the, today in these, how much, 20 minutes or so, I'll talk about whose income and whose value. What do I mean by that? When I looked up the dictionary definitions of capitalism, these definitions, which are, I'm sure, quite familiar to everybody in the room, come up: an economic system in which investment in and ownership of means of production, distribution, and exchange of wealth is made and maintained chiefly by private individuals and corporations, especially as contrasted to cooperative or state-owned means of wealth, and so on. Here's the income statement of Microsoft Corporation. For 3 columns, give you data for most recent year, 2010, 9, and 8. At the top, I'll just read down the 2010 column. They had a revenue of about 62 point some billion dollars, out of which they subtracted various expenses. Expenses were cost of revenue, which in case of a merchandising firm might be the price they paid for merchandise, and this cost of revenue in case of Microsoft will probably be the cost of running their operations. And then there's sales and marketing. Delighted to be here again this year. Last year's experience for me was really a very pleasant and very fruitful experience for me to learn about much broader perspectives on our economic system and capitalism. So I was delighted to be invited back this year, and thank you for this opportunity.